Hello, welcome to FinTech Impact. I'm your host, Jason Periera. Today on the show, we have two guests working on the same thing. You have Srikanth Narayan, CEO of Cash, and Wesley Gray, CEO of Alpha Architect and ETF Architect. And they've come together to basically bring 351 exchanges to the masses. And I'm going to get into what those are and how they go about doing it in our interview. And with that, here's my interview with Srikanth and Wes. Srikanth, Wesley, thank you for taking the time today.
Appreciate you having us.
Thanks for having us.
Well, thank you. Srikanth and I have talked a couple of times. And when he came to me with this, I'm like, wait a sec. I met with Wes in Puerto Rico and discussed this exact concept. So when you guys were teaming up together to get this done, I was pleasantly surprised, and I finally found an excuse to get Wes on the podcast. Thank you for that. Let's jump into we're going to jump in first into what the company is. I'm going to jump into both of your histories and then why coming together makes sense here. So, Srikanth, CEO of Cash, tell us about Cash.
Great. Cash is a company I founded about 3.5 years ago. It came out of my own personal struggle with concentrated stock positions. The way that we think about Cash is it's a modern brokerage for concentrated stock positions. And we build sophisticated solutions to help solve this particular problem of concentrated stock solutions. The first and the flagship product that we started with was the exchange fund. And that's where it's actually slightly different than 351 exchange. It is based on IRC 721. It's a different structure, but we'll get into how.
We'll get into the depths of it. Bottom line is at its core, not an uncommon problem. People work for an employer or help found a company, and they have this large amount of stock that maybe you did well on a position, very large embedded gain, and you don't want to take the capital gain if you don't have to, but now you got this disproportionate risk to your wealth that, especially if you work there, now your human capital and your financial capital tied to the same company. We've seen this go wrong. We've seen it go wrong with Enron. We've seen it go wrong with every blow up where people have too much stock in their company's portfolio. So let's dive into basically your histories, right? So Srikanth, I'm going to turn back to you. You basically saw this problem, but before that, what did you do and what led you to start it?
Yeah, I like to joke that I was working at Waymo building self-driving cars, and one day I woke up and decided to be an asset manager. But before that, I was working at Uber, and I was an early employee there. And after Uber went IPO, a lot of my own net worth was tied up in that one stock. And I was trying to figure out ways to take the risk down and do it tax efficiently. That's when I came across exchange funds. And when I started to go around to my friends and survey them, how come I have never heard of this? They had never heard of this concept either. That kind of struck me as odd. There are hundreds of thousands of people in my social network itself that have massive concentrations in their portfolio. They have no idea that they can diversify tax efficiently. The only two strategies they know is hold and hope or sell and incur huge tax gains. That's what led to thinking about a product and a brand built around solving this problem of concentrated stock positions.
Tell us about your background.
Sure. So I'm more complicated, of course, because we have two businesses, but I'll keep it short. So we started Alpha Architect around 15 years ago, and it was a good old-fashioned asset manager, think AQR, but with less smart people and less AUM.
It is funny that you referred to that as old-fashioned, but continue.
So we did that, just grinding away. We've always been very focused on tax-efficient investing and structures just for our own products. And then 6 or 7 years ago, our mutual friend Perth Toll reached out, said, hey, you guys have been running ETFs out of your garage for 10 years. I hate everybody else. I'd like to work with you. Can you launch my ETF? To which we said, no, we would never do that in a million years. But she's very persuasive. And eventually we said, sure, let's try it. So then we started another business.
I can see how that would work out, but continue.
Yeah, you know how it works. And that became a business that we spun out, which is now much bigger than Alpha Architect, called ETF Architect. And ETF Architect is basically access to the ETF marketplace, where you show up with an idea, you show up with some capital. We basically do all the work to launch, manage your ETF. And one of our specializations and how we end up getting tied in with Cash is we are very, very focused on tax-free exchanges. So how do you move assets from point A, like SMA, other vehicle, into the ETF structure, which is how we got here. That's why we have $22 billion and double every year, because people apparently don't like taxes that much.
No, they don't. And you created a platform for both asset managers and for structures that are going to basically help with that. Yeah, taxes. No one loves taxes. All right. All right, so sir, let's talk about the options that exist for how we go about this, okay? So I'll let you handle exchange funds. We'll go back to 351 exchanges with Wes, but let's go into how do the exchange funds work? How do they go about being done? And what's the burden of work that is required to do so that makes things easier on?
Yep. So we've been talking about 351 exchanges, and 351 part of that name comes from revenue code, and that's the code 351 that allows for tax efficient transfers into a corporation. There's a similar tax code called 721 that allows for tax efficient transfers into a partnership. And that is what exchange funds rely on. Exchange funds have been around forever. And Wes will say that 351s have been around forever, but it has been a strategy that only the ultra wealthy have been able to access. You need access to a private bank and very, very high minimums. So there were two institutions that have been doing it for the past 60 or so years, very high minimums and high barriers to entry. But the concept is quite simple. It's a partnership where a lot of people come together and put all of their stocks. If you're selective about which stocks you let in, you create a very well-diversified pool. And as long as it's structured correctly, no one incurs any taxes upon this transfer. So somebody comes in with a concentrated stock position and they get back shares in this diversified pool that is being built. They're diversified, but no taxes were triggered. There are rules around how to structure it. There is 80-20 rule, which people will hear about. 80% of the fund needs to be held in equities, 20% will be qualifying illiquid assets, which is real estate. People need to hold it for at least 7 years to get the diversified basket out. But that is the overall picture of how an exchange fund works. And what we saw as an opportunity is how do we make this concept that has served particular, let's say, a 0.1% of society and make it more broadly accessible.
At the end of the day, someone has to assemble all these components in order to create the fund in order to make it viable, right?
Yes.
So you're trying to bring that to the masses, and simply by basically making a platform that gives people access to participate, and you're also distributing through advisors. So your sourcing problem is solved. Okay.
That's right.
Great. All right. I'm going to thank you for that. That's great. The exchange funds. I'm going to turn it over to Wesley for the 351. So tell me what this is and why you're involved.
Yep. So just stepping back, one thing that's very nice about the ETF, generally speaking, as everyone knows, is it's very tax efficient, it's very transparent, and the fees are generally really low.
Some countries, it's more tax efficient.
In particular, I'm talking about all my comments are obviously very US centric because that's the environment
It's
I live
okay.
in.
It's most of my audience anyway.
Yeah, like Canada and other areas, it's a little bit different. But down here, it's a panacea in many respects for managing your capital. The problem, though, is a lot of people have assets in other locations that have low basis. And so they're stuck. They're like, geez, I would love to put my money into an ETF and benefit from low cost tax efficiency. But how the heck do I move from current to that? And so that's where Section 351 comes in, where it's a statute. Tree has a statute as well, where we're essentially able to set up a new C corporation that is basically a new ETF. It's a RIC, registered investment company, so don't get double taxed. And the code basically allows you to contribute diversified portfolio contributions tax-free in to form new ETFs. And so we've basically specialized in maneuvering that landscape and launching ETFs that, you know, take advantage of this part of the tax code, essentially.
Okay, good. So you basically are providing effectively the back end of the ETF origination, whereas Sri is basically providing the flows from his distribution model here. It makes perfect sense. You already had a pre-existing structure to provide that.
There we should get into is the 351 is a vehicle that you can access if you have a highly diversified portfolio. There are certain rules around how diversified the portfolio needs to be to transfer without incurring taxes into a corporation or a newly formed ETF. And when you are a concentrated stock holder, you do not have the level of diversification access to 351 itself. And that's where exchange funds have been the solution. The problem with exchange funds is whenever you're trying to build, let's say, a Russell 3000 or an S&P 500 ETF, you need to source people that hold all of these different components. And most of these components have barely moved at all in the last 15, 20 years. So nobody is out there thinking, I really need to diversifying my utility stock because it is appreciated like 20x. It's all the NVIDIAs, it's all the Metas, it's all the Costco's of the world that are looking for this tax efficient diversification. So you have this natural imbalance that occurs with the supply that's coming in to us. How do you take that to the S&P like structure without the limitations that or the inefficiencies that the traditional exchange providers usually have into?
Yeah, that's a very valid point. Stock market returns are concentrated in the hands of very few securities over time. So it's not unusual that you have to have the problem of massive capital gains in the first place to be worried about this. No one's saying, oh, I'm up 20%. I don't want to take that hit. They're more worried about the thing that's 4 or 5x. Okay, fair statement. What we basically said is you had two problems that the both of you together have solved for is how do you, in order to bring this to the masses, how do you source enough people to do this as opposed to making this a exclusive thing for private banking at upper levels, which you're doing on your end. And then how do you actually do the mechanics of this and actually make them happen? You're not going to start a standalone. Being together, the both of you makes so much more sense than either one of you trying to do it on your own, which makes perfect sense. Why when I was poking you guys at Alpha to do this on your own, you ended up going this way.
Yeah, and just to quantify it, just how much it's been democratized, because we're now 30 deals deep and doing this for pretty much everybody, is when we started doing 351 deals, the minimum was around 5 mil. Now, especially with Schwab, we've got it down to 150K per client. So I went from only rich people because just logistics were insane. And now we got software systems, what have you. We're down to 150K. And then Sri, you can talk about how low you've got it down on the exchange fund side.
Most of the institutional exchange funds start at about $1 million minimum. We are down to 100K on our minimum. Most of them close once in 3 months or 6 months. We close every 2 weeks. And because of the operational challenges that we involved in bringing all of these together, they just end up charging an arm and a leg, like usually run quite high in terms of fees. We've brought those down almost by 50 to 75%.
Realistically, people are going to hear that 100,000. Oh, it's not exactly mom and pop stuff. But in reality, you wouldn't need it for mom and pop stuff. No one needs to really worry about this when they have a $10,000 gain in most cases. Don't get me wrong, no one wants to pay taxes. They don't have to, but we're talking about something that's gotten so big it's disproportional to relative wealth. At $100,000, to me, I don't know that you bring it down any further. Maybe you think there's a market there. Reality is, who really experiences this problem? It's people who've had this run up, and federal level, you're still going to be paying. You're going to be paying what, on a $100,000 gain, $20,000 in taxes, throw on state on top of it. That's material even to like anyone in the middle class. So I think you guys have brought it down to effectively what is the democratized level pretty much.
Yeah. And the one thing about this is these are what are called regulation deemed private placements, America. So they can only be open to accredited investors, which is about $1 net worth. If somebody has a concentrated stock problem and they're effectively a millionaire, they would have about $100,000 or more of one stock. That's why we landed at that particular number.
Yeah, I mean, I think to me, it makes, again, the regulation makes it harder to get around it. So overall, I guess this was, I don't like to say no software companies, no things ever done, but this looks pretty well packaged together. Where do you see this going from here? Is it just a matter of getting the word out and then like potentially increasing the frequency of the opportunity for this because you start getting enough deal flow, or is there something else you have planned you can share?
We started with the NASDAQ 100 and in partnership with Wes and Alpha Architect launched an S&P 500. We are launching an S&P 500 growth and will increase the index selection over time. A lot of it is how do we get even more efficient and precise about the supply gathering, because we really need to gather supply from hundreds of different stocks. How do you make the process as efficient as possible and with the efficiency pass that as savings to the client? Those are the things that we're working on. And generally, we think of ourselves as a solution provider for concentrated stock positions. So there are a lot of other solutions beyond exchange funds as well that we'll need to look at over the coming years.
Yeah. One of the things we talked about previously was like the idea that on large enough accounts that even have diversified portfolios of stocks, if you have one thing that just basically goes gangbusters, this is not just a matter of a tax play. It's a rebalancing play. It's a massive rebalancing. So even if 50% of my net worth isn't tied up in this one thing, but like, hey, my position, it's a super large portfolio. My position's gone from where it should be at 5 to 15%. it may be worth it just to basically do that and reallocate to moderate my risk.
We meet a lot of folks like that. They held a small position in NVIDIA. It was 5% of the
No small positions in NVIDIA anymore.
now it's 80% of their portfolio. They held a small position in Palantir. Now it's like 50% of their portfolio. Those are not employees of these companies, but like people who just invested in these companies at the right time and just seen like 20x, 50x, 100x growth from it.
It's a great strategy because too often some strategies that are overly tax strategies tend to have a lot of somewhere there's a risk somewhere, right? Like somewhere, a lot of the tax stuff that's out there in this world is, okay, we can eliminate this, but now you're taking on some other form of esoteric risk to do it. What you're actually doing is you're doing the right thing. You're taking, it's an incredible tax benefit, but it comes with the benefit of diversification, which like win-win in both cases. So frankly, if anything, what you're doing is a service to investors and the marketplace in general. Good.
Yeah, I'll just double tap on that for you because a lot of people are
Military term, go ahead.
There's literally all these articles that I feel like they target us specifically because all our different tax things we do seem to be quoted. But what I always tell people, and I'm sure Sri runs into this, is if you have a kind of hodgepodge portfolio with low basis, you're not going to sell it anyways. You're just going to sit in too much risk and be under diversified. So it's not like the tax authorities are going to get any more tax dollars. All like the real business substance is we're helping people get better diversified more efficiently. That's great for society. It's great for lowering cost of capital, et cetera. It's not necessarily a huge tax avoidance because no one would have paid the tax anyways. It's just deferral, but smarter.
Yeah, it reminds me of when I first started and I helped research for the broker I was working for, a couple of biotechs, and he 5x'd one in 6 months. And I remember him sitting there going, I don't want to pay that tax bill. And he sat on it. And then sure enough, the thing reverted and he ended up at a loss. And it's like, well, it looks like you don't have that problem anymore. And so you're right. It becomes a friction, and especially as securities lending becomes more and more accessible, right? Like people have these massive deferred capital gains. And it's like, well, I'm just going to borrow against this going forward, pay zero tax on it, and then I die and the bump up basis happens. And now zero goes to the feds, right? You're right. It's not simply, hey, we're completely robbing the IRS of revenue. No, that revenue probably didn't exist the way they thought it would. And if anything, you're letting people be better, like a bit more like the risk management and potentially actually pay more tax. If I have a position now that basically is more diversified and slots into the rest of my S&P 500 diversification, whatever else it is, I got a different lot basis. That's all it is. And if I got to trigger tax, I'm going to trigger tax over here. So it's not robbing Peter to pay Paul. It's not eliminating anything entirely, but it is changing the behavior and making it more beneficial to the investor in the end.
Not to get macroeconomists on us here, but if you could argue that this is lowering frictional costs and lowering cost of capital, i.e. raising overall asset values at a macro level, you could argue we're actually increasing the tax base because if we're lowering cost of capital macro, and that's implicitly raising the value of all assets, hey, government, you actually got more capital gains to choose from now.
In addition to that, we're eliminating the asymmetric risk of the individual position, bringing it down symmetrical to basically systematic risk. And now when the tax bill eventually happens, the probability is that tax bill will be there as opposed to the one company that just runs up and runs down.
Yep, exactly.
It is simply deferral. It's not elimination, right? And I would say a lot of this is dead weight loss in the economy. People are just holding on and taking undue amount of risk. But if you can get them diversified, it's likely more liquid. Wherever liquidity needs, they'll be incurring taxes on a much higher base. It's better for the individual to be taxed later. It's probably better for the government to collect that tax later as well, because it's going to be off of a larger base.
It's just funny. The IRS comes knocking and be like, no. We're reducing the standard deviation of your tax revenue.
Exactly. We're increasing the odds you get to charge more tax in the future. Get away from us.
Like we're making sure that large gain stays as large as possible for as long as possible so that you can collect it. You don't have to worry about mean reversion.
I agree, but we're also biased, is what they're going to say.
No,
which I can't deny that. We are biased.
You're incentivized to be biased, so of course you are.
Yeah, exactly.
Absolutely. All right, so before we wrap up, there's 3 questions I ask everybody that's going to shed some light on some other stuff here that I think is going to end on a positive note. I'm going to have each of you answer individually. Sure. First question I have for you is, if you had one wish for something to change in your company or industry as a whole, what would it be?
For me, it's just be more transparency. There's a lot of pockets of our business where people just do not understand what they're investing in or why. And
Yeah.
if we could somehow fix that, I just think it would make people better decision makers.
And if anything, the trend's been the opposite direction with the move towards privates, where the lack of transparency is not a bug, it's a feature.
The industry likes it because that's how you charge more fees, bury more bodies, etc. Transparency.
Launder
is
your
not good.
volatility, you name it.
Exactly.
Yeah. Right.
I would add financial education, which is also making information about these products transparent. There are so many products that have an unbelievable value prop, but then kept behind layers and layers of red tape or like access that most people do not know that they exist or do not understand how they work. That just enables the wirehouses to get more fees.
You call this a product, I call it a service, quite honestly. Like you've stood up a service that's going to result in the end civil product, but what you've done is transform money into the equivalent amount of money, but just a safer version. And you're just helping me de-risk.
Yeah.
Second question I have for you is, what's been the biggest challenge in the company to where it is today?
I can take that one. We've been around 15 years. For the first 10 of that, it was less than 10 people. And now we have 50 and we double every year. And we've never really been in growth organization build. And that's just a new experience, and all the challenges that come with that have been interesting to say the least.
Scaling of bodies and people. That's not an uncommon problem we encounter.
Yeah. From our end as well, we launched about 16, 17 months ago. And I think the product has been compelling enough that grown quite fast. But the biggest barrier thus far has been the only two other service providers are, let's say, 150-year-old banks. And we are this new, almost unknown entity that has a compelling pitch, but the trust barrier is hard to build. So it is a lot working one by one and building the trusted relationship with each individual and RIA that we work with.
I get it. It's a sales pitch that says, hey, give me your multi-million-dollar position. I'll give you back something else. And it's just like, give me who are you? You've productized the entire offering. You made it simpler, cleaner, more efficient, less painful. Like the 150-year-old banks are still going to make you walk across hot coals to get it, right? So it is what it is. And people will learn sooner or later that service offering is going to basically be the easier way to get it done fast. Yep. I guess the last question is, what is it about what you're doing that excites you and keeps you getting out of bed in the morning to keep on fighting a good fight?
For us, we're obviously in the ETF industry. It's all about affordability, transparency, and low cost. And there's so much capital that is not being treated like that. And so it's just awesome to be able to help people out and help them save a lot of money and just get their financial life squared away in a low cost, tax efficient, transparent way. Why not?
Bogle gets a ton of credit for all this, right? I can't remember what the quote was on the estimated amount of fees he'd saved the American populace over time. And it was just
it's unbelievable.
staggering, like the cumulative GDP of several nations over years, like absurd.
That's why we always say we're just trying to vanguardize this little vertical, but we're just like a little micro dot. He obviously did it at the grand scale. So we're just trying to pitch in along the ride with them.
And you're pitching in creative ways and different ways that basically the bigger players don't have to be as innovative. And you found ways to be innovative and provide immense value in that regard.
And for me, I'm in San Francisco. And I started this company around this thesis that people have considered stock positions and we can help with them. What has really surprised us is how rampant and how widespread this is. Every single day we meet folks come to us and say, oh, 80% of my net worth is in Microsoft, 9% of my net worth is in Apple.
That problem exists in the Valley? No, I'm shocked.
And yeah, it's been humbling that this fit the market needs so well. And we've been able to educate and help all of these folks move on to her less risky financial future.
Absolutely. Especially the engineers in that town, because at the end of the day, their human capital is literally tied 100% to every possible employer today. Gentlemen, thank you so much for your time. Greatly appreciated. This is watching this journey and seeing this connection and making it has been interesting, because frankly, I think that I wish I had the opportunity to do the same thing in my country. Damn Canadian tax code. But I'm glad that I'm going to be happy to watch you two run with this.
Thank you, Jason.
So that was my interview with the two gentlemen making cash a thing and helping people basically make 351 and exchange funds democratized to the masses. And I often, if you've heard me on this podcast, complain about the term democratization being nothing but taking advantage of the small guy. This is the exact opposite. So I hope you enjoyed that. And if you're looking for them, please take a look at the website at cache.com. And with that, until next time, take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at jasonperera.ca.